Nau mai, haere mai, piki mai, kāke mai, ngā mihi o te rā. A tēnā tātou, kua whakarau ika mai, raro i te tuanui o tānei whakapiripiri ka aku nui. Ka aku rahi, ka aku rangatira, tēnā koutou katoa. I'm Guy and Espina. Welcome to this session. We've got a real heavyweight panel. Have we got enough chairs? We've got so many heavyweights, I don't know we've got enough chairs. We're going to invite Rob Everett back up as well once we find a chair for him. Actually, I think the insurance industry is taking it away. It's about having a seat at the table, isn't it, as they say. So welcome to you, Stephen. Stephen Finlay is with us, Head of Prudential Regulation with the Association of British Insurers. Welcome to you. Jeff Baskand is with us, who is the number 2 Deputy Governor of the Reserve Bank. Welcome to you. Nadine Teddy-Order is with us, the CEO of Fidelity Life. Kia ora, welcome to you. We've got David Talbot, who's the CEO of UMR, who's going to provide us with some data insights this afternoon. Welcome to you, David. And also with me, way down the end there, we've got, from a legal perspective, we've got Tim Williams, who is with Chapman Tripp. Welcome back. We still love you.
I thought I got away with that. I should have left whilst I had the chance.
No. And thank you for your address. And actually, we'll pick up where Rob left up. And let's start with you, Nadine. You're in the hot seat there to some degree. Are you waiting for the FMA to come knocking? Definitely not.
Definitely not. And I think Rob's message is very clear. And I think, there's two aspects for me. One is obviously the opportunity I have as a leader in the industry to actually influence at a broader level in terms of having one voice that represents the entirety of the industry, but also in terms of leading Fidelity Life. I think, we've been on a customer journey probably the last 3 years in particular since I've been at the helm, and I think it's really, really important that we continually step up to putting customers at the heart of everything that we do. And that's not just, as Rob said, about talking about it, it's actually demonstrating that we are. And I think it's also about, really talking in a balanced way, in the sense of, we do already some phenomenal things for New Zealanders, and I think some of the stats at an industry level that we saw this morning, we've paid just over 1.4 billion in claims, and I think that's a really, really important service that we provide, that, New Zealanders at their time of need, we're there for them. And I think we need to get the balance right around educating New Zealanders on that part of the story, but also we have to get the balance right around restoring trust in our sector and trust with customers. And restoring trust actually does start with us.
Do you think it's a fair cop, though, when it's said in that review by the FMA and the Reserve Bank that few life insurers had given any serious thought to conduct and culture prior to this review? I mean, it was a fairly damning review, wasn't it? Was it a fair cop?
Look, I can speak for my organisation. I really think at the end of the day, culture is leader-led, and culture's, it does go hand in hand with conduct. And I think there's always room for improvement, always, because you can't sit in a senior role and assume everything's perfect and we're getting it all right, because that would just be lying, because we're not. But I think what we can say is that we are stepping up to the challenge, and I think that has absolutely got to be something that is, as I said earlier, not lip service. We've actually got to demonstrate that change and that we are actually making strides forward.
Okay, I want to bring you in, David. David Talbot from UMR. We heard Rob saying that public trust in financial services as a whole is at historic lows across the world. He said it was a little better in New Zealand, but really public trust has been shaken. Does your research bear that out?
I think research in general worldwide bears out the kind of shrinking circle of trust overall. I think there's a real crisis of trust worldwide, whether it's NGOs, whether it's government, whether it's financial institutions. So I think that piece of context is really important in terms of, starting off the conversation. But yeah, in terms of the sector specifically, a lot of you will be familiar with the PR agency Edelman, who do a global trust index. They publish that yearly, and the latest version of that has definitely got some kind of concerning figures in it. There's good news that trust in the financial services sector has risen from 49 to 57% over the last 5 years. But the bad news is that as a sector, it's still the least trusted of all the sectors they measure. So I think there's no room for complacency, and this is definitely the right time to be having this kind of discussion.
And Stephen, if I could bring you in, perhaps from an international perspective, is it similar what you're seeing here to what you're seeing perhaps in Europe?
Yeah, absolutely on the trust point, and I think a lot of that stems from the past 10 years of austerity that we've seen in the UK, which was triggered by the global financial crisis, the very public bailout of the banks, a range of sort of conduct scandals which happened around about the same time, and the result of that is that in the UK at least, we for the past 10 years have had a series of regulatory reforms which have been thick and fast and quite unrelenting, both on the prudential as well as on the conduct side of the coin. Prudential side very much about repairing and restoring the balance sheet, new systems of governance or of risk management, and putting policyholder protection really at the heart of a whole new regulatory system. That was driven by Solvency II reforms at the European Union level for us back home. Meanwhile, on the conduct side, there's been a lot happening there in the UK, much more driven by our own regulator. Since 2013, we have had in the Financial Conduct Authority a dedicated regulator who has provided a lot of very close and continuous supervision on a range of the conduct issues which were talked about earlier on in sort of Rob's keynote, and that covered a lot of the issues which I've seen raised by the Australian Royal Commission and by the Conduct and Culture Report, which we've seen here, and that's freed up resources, management time in firms, and has looked at selling and pricing practices, a whole reform of the financial advice market, and a lot more senior manager accountability as well in firms. So a lot of changes already in the UK, and very similar, I think, to the ones which you're seeing happening here now.
Okay, Rob, can you see that second question there? You read that out and tell me whether it's true. It's a good question.
Yeah, it is a good question, but not for the reasons of the person who wrote it. The FMA has never prosecuted a bank or insurer. Should FMA be adopting the new ASIC approach of why not prosecute?
What's the answer?
Yeah, so there's two parts to that question. First of all, we don't regulate banks and insurers at the moment, so let's be clear as to why we recommended to the government that they build a lot of the obligations I talked about in my speech to build the systems and the governance that generate good outcome into the law so that we can enforce it. So first things first, no, we haven't prosecuted a bank or insurer, but that's largely because A, those obligations don't exist in the law, and B, they don't sit with us.
So who could prosecute a bank or an insurer?
Well, that's the problem. I mean, there are provisions in the Fair Trading Act, there are provisions in the Financial Markets Conduct Act, there are general provisions of law which could be used to prosecute a bank or insurer, particularly around mis-selling. And it's true, we haven't taken one of those. Obviously, the Commerce Commission has taken quite a few. If we have our way at the FMA, the government will bring in a regime that gives us a clear mandate to take on that piece of financial services.
So you want that power that question is asking about?
Yeah, absolutely. That's what we asked the government for. And the question of how you go around supervising an industry, particularly where you are somewhat moving the goalposts, as I acknowledged we have been doing in the Conduct and Culture Review, is a tricky one. But for sure, as a regulator, we have to be willing to take on the biggest vested interest in financial services.
Would you have pursued prosecutions in anything you saw, and you don't need to name names, and I know you didn't in your review, would any of those resulted in prosecutions?
We have a few pieces that we looked at as a part of that review that are still under investigation for prosecution. So yes, we would be willing. We didn't see We didn't see much. I have to say that certainly we thought was systemic. But again, as I said in my speech, it was a pretty quick and sort of brutal review in terms of how much it tried to get through in quite a short time. And we're not completely confident that if we spent longer in those institutions monitoring, we wouldn't find stuff that needs prosecution. And as I say, we do have a few pieces, particularly out of the life insurance review, that we are still actively considering whether to take court proceedings.
Jeff Baskand, if I could bring you in here. It's a shared responsibility, isn't it, regulating banks with the FM? Well, actually, the Reserve Bank has the primary role there, doesn't it?
We have a primary role in the soundness of institutions. Now, I guess I see conduct as sort of like a window into the soul of an organisation. Rob's responsibilities are principally about the conduct. Ours are principally about whether that institution is run soundly to be there safe in the long term. But if you can't look after your customers, how much do you trust the institution to look after the investments, the money that's supposedly in it and so forth? So yeah, it overlaps in that sense, especially when you get to governance and risk management and to systems. There we have an overlapping interest that those are working both in the interest of customers, but also in the interests of long-term stability and durability of that institution. And you see when it goes wrong. I mean, it's not that long ago we had massive finance company failures. They were, many, where transparency was poor, where governance was poor, when there wasn't much capital behind them, investment promises were weak. Those institutions often poorly run. And, I'm not saying the sector's like that now, but that's sort of what happens if you don't do these things all properly. And so we've got to have good governance, good risk management, good systems, and good treatment of customers. They go hand in hand, in my view. And so we in the FMA are working much more closely together, I think, than we ever were. The coordination of regulators is a really important thing. If this legislative agenda comes through in the way we anticipate, that's going to force us to continue to work out how to coordinate in our licensing and our oversight of institutions. We need to do that well for the institution's benefit as well as for the country's benefit.
Tim Williams, Chapman Tripp, if I could bring you in here. I think I heard a bit of a sharp intake of breath when Rob was saying that he wanted the power to prosecute banks and insurance companies. What else should we expect to see come down the line, legislation-wise?
Well, there's considerable legislation being brought through in relation to financial advisors at the moment. In fact, many of the people in the room probably are pretty well worn at dealing with the legislative changes at the moment. But that's probably one of the prime focuses, I think, coming forward. And it's particularly relevant in the context of customer outcomes, because, of course, financial advisors, as Rob said, are absolutely the coalface of dealing with customers. And so that's probably a pretty good place to start, I think. And we've had since 2010 the Financial Advisors Act, which covered to some degree important aspects, and that's now going to be considerably bolstered through the Financial Services Legislation Amendment Act.
Nadine, if I can come back to you, and thank you for these questions. There's some good. You're doing my job for me. Well, these questions are popping up on the screen here. Nadine, that question at the top. Are insurance companies worried that putting customers first will mean less profit and less commission? And is that the reason that you haven't changed already?
No. I think existing customers are actually more profitable than attracting new ones. And I think that, and Rob picked up on this, it really comes back to how we actually are monitoring our products as they get older, and what mechanisms have we got in place in terms of process and connection with customers and support that we provide our advisors in terms of making sure that those products remain fit for purpose throughout the life cycle that they're with us. I think that's probably more where the opportunities lie. It definitely isn't about worrying about losing profits in terms of not putting customers first. I think that's couldn't be further from the truth, because in fact, if we put customers at the heart of everything we're doing consistently, we actually would be far more profitable longer term.
You talk about financial advisors there. Actually, Rob, have you spotted something?
Sorry. I quite like the look of the one of the questions on here. I'll read it out for you.
Shall I just go and sit down?
Yeah, you're good. I wanted to get in before I go and let someone else answer it. So the biggest problems in the industry for conduct remain in legacy products. Why not focus more specifically on these problem areas rather than contemporary products which are fundamentally different? It'll be interesting what some of the rest of the panel think. I think there's some truth in that. I don't think it's entirely true. I think there's plenty of products being designed today that probably aren't fit for purpose. That issue of legacy products is absolutely one that in our review we spent some time on, and we have been talking to the industry about, and this is an example of changing expectations, right? So products that were perfectly valid, market standard, appropriate fees, appropriate design 15 years ago are quite likely not to be appropriate today.
Can you give us some examples of what sort of products you're talking about?
Well, it would be as simple as investment products where the fees, for instance, would be in the 4 or 5% range, which might have seemed fine when equity markets were burning red hot and interest rates were high. But when you've got interest rates incredibly low and overvalued equity markets, those products start to have quite a different shape. And if you're locked in, which has been the method for financial services, which is to sell you a product and then lock you in. And providers are not going back and saying, would we sell this product today? If the answer is no, why have we still got customers in this product? And there might be a good answer, and those customers might want to be in that product. But the legacy products is an absolute lightning rod for the conduct stuff we're talking about. It's, have you gone back and looked at this and asked yourself, is this fair? Not if it's legal. Is it fair? And if it's not fair, do something about it.
Stephen?
Well, and to pick up on the theme of, and if you don't do something about it, then it will probably get done to you. I mean, that is sort of exactly what happened to us in the UK, where on that very issue, in fact, of annual management charges on legacy products, a combination of a lot of pressure from the press as well as politicians on charges which were acceptable when the product was written, but were now deemed to be excessive, led government to legislate for there to be a cap, and that in the UK was set at 75 bips, so a huge cut from the 4 to 5% that was on some products. So that's an example of what has happened to us in the UK for not being on the front foot of on issues like that.
Jeff?
Well, I mean, I think we all think of examples where we've bought something and then been locked in for a while, and then something's come along better from the same provider, and we can think of certain television products or telco products or insurance products, and you go, why are they getting that when I'm not? And sort of not having that discussion and that offer and these things. So there's lots of dimensions of this. But I suppose what I'd like to make is a point that I think Nolene was touching on. Simplifying your business, working through your product range, working through your processes, working to say, is the best and the simplest and the most efficient way we run this? That's good for customers as well as good for the business. So I think there's a lot of alignment here, and having the organisation knowing that they're streamlined, they haven't got 150 things they're trying to manage in complexity. That's where risk comes. Sure, you need customisation in some degree, but I don't think we should always think of these things at odds. We talk with banks and financial institutions, insurance companies all the time, and they're on this, how do we digitise, how do we simplify, how do we streamline, and thereby make the customer sort of more powerful at the end of that channel in a more simplified fashion. And so I would argue that, there is a big alignment between business benefit and customer benefit here.
To add to that, I also think that it's really important that we give our people freedom within a framework to actually do the right thing at the front line for customers. And part of that is, to your absolute point, Jeff, it's around having the right processes and the right systems in place to enable them to have the tools to actually do that. And I think the more that we can actually get that message through in our organisations, the better outcomes we are actually going to have with customers, because it's real Kiwis talking to real Kiwis at the end of the day. And I think we've all heard, from the telco industry that customers absolutely hate being shafted off overseas or put on an IVR system to press 1, press 2, blah, blah. I think the more we can actually give our staff the frameworks, to have the freedom within to actually do the right thing at the front line, the better the outcomes will have and the better the trust factor will be.
David, how aware are players in this industry about what the public perceive their trust to be and their integrity to be and their brand to be, do you think?
I think increasingly aware. And I was just going to say, to just join to some of those previous points, was that fundamentally trust drives loyalty, and so, separating out price from trust is often not the right thing to do. Often they're just really closely connected. And I think that in an industry, sort of on the edge of some disruptive forces, that building that loyalty and creating a stronger connection between public and institution is actually of massive advantage. Not only is it the right thing to do, but I think that it'll, get good outcomes for players in the sector as well. And back to another point, this bit about getting stuck on a legacy product that turns out not to be, the best option now is something. I do a lot of work in the electricity and power sector. And if I had $1 for every time somebody said to me, it really annoyed me to find out that my neighbour just got offered a better deal when I was stuck on this old one, that fundamentally, it's a problem of trust in that provider that's going to have effects that you see having an effect in terms of the research, every day. So I think there's, getting these two things closer together, trust and loyalty and profitability, there's a real kind of Goldilocks space there that people can seize.
Tim, this presents challenges for someone with a legal mind, doesn't it? Because we heard Rob say there, is it legal or is it fair? And I guess, not to cast any aspersions, but you're looking at whether it's legal, aren't you?
Generally, we do a number of other things as well, of course, but our starting point and reason for being is, of course, the law. But we recognise what the FMA is trying to achieve, and it's within the mandate that they have to try and improve fairness, efficiency and transparency in the market. So we've had our times as a firm particularly where we've debated whether the messages coming out of the FMA and the RBNZ have overstated whether this was a legal requirement or something that they were pushing for under that mandate. But I'm happy to say that Rob particularly, but others have taken this on board really well and acknowledged clearly that the role is the distinction between misconduct and bad outcomes being something that is less than good outcomes but not necessarily illegal. The transparency and communication on that is dramatically improved. And we now, are getting clear messages that this is about the industry good rather than legal compliance. So I think things have moved dramatically in a positive way there too.
Another good question here. What does fair mean? How do you adjudicate that in the corporate world? Kids can explain it, yet we struggle. Who wants to pick that one up?
I could have a crack.
Yeah. Cut a fewer.
It's a great question. And some of the notes that I'd sketched out initially were about, what trust does mean and why we should care. Because it means different things in different contexts. Whether you trust your spouse is a very different question from whether you trust your telco provider might be a very different question from whether you trust a financial services provider. And I think, when we're talking about falling trust in some industries, we just need to be careful that we're sort of comparing apples with apples across all these different sort of areas of life. What the public say really matters in terms of trust is a bunch of hygiene factors that won't come as any surprise to you. This is things like acting with integrity, being honest, fixing problems when they arise. But increasingly, I think there's something a little bit more amorphous to this idea of trust. That's not just about those kind of black and white things. It's about using all the data points that they have to predict kind of future behaviour. And at the moment, for a bunch of people out there, the data points they have are kind of pulling them in a negative direction. They see something in the media, they've heard a story, they've talked to a friend or family member that's given them a kind of a negative impression and then consequently when you ask them if they trust, they say no. On the flip side, and we see this in the insurance sector, people who have had claims typically are more trusting and have higher favourability ratings for providers. So people who have had a good positive outcome that's close to them personally, go the other way on trust. In the middle, there's a bunch of people who just don't feel like they've got enough data points to make a call. And I think that's again why I think this is such a time of opportunity, because I think we are in a slightly different position to the rest of the world. And there's a massive opportunity now to seize that kind of 40 to 45% of people, who are a bit unsure about trust and give them more data points. And those are more data points than just the hygiene stuff. I think it's about the financial services industry telling a better story about kind of what the benefits are overall to society. It's got to be more than just personal benefit. I think there's a bigger piece there as well. And if you do both of those things, the hygiene and the storytelling, about choice, about sort of empowerment, I think there's again a really nice narrative there that can shift trust in the direction that you want it to.
Okay, I'd like Nadine and then Stephen to respond to that, and then I think we might move on to banks, because we've had a fair crack at the insurance industry and I'm itching to get into the banks.
That's great. That sounds good. I think I totally agree with the comments that have already been made, and I also think too that we're getting into the realms in terms of fairness. For me, could be quite different from fairness for you, for example. And I think the data points are really, really important. And I think it's about knowing me as a customer and knowing what fair means to me in terms of the products that we provide, the way in which we provide them, how our advisors interact with customers in a way. And I think too, just on that, it's written, and Rob reinforced this putting customers at the heart of everything we do and reinforcing fairness and trust is actually about how can we get the sector to thrive. And I think that is as much around, face-to-face advice is really important. It is really important. And that builds the sense of fairness. I've been heard. But it's not just about selling a product either. It's actually about being there when something goes wrong. And I think these are this is the balance I talked about earlier. We have to somehow find a way as an industry to balance the good work that we do and those stories with the data points, as you say, but actually get those things out there, and that starts with education right at a grassroots level. It's not just about yes, financial literacy is really, really important, but so is actually future-proofing your future and understanding what actually an insurance product does.
Yeah, I think the point that David makes around about trust is a really interesting one, because I think research that we've seen in the UK is that the public, when asked generally on their views on insurance, trust the sector quite poorly. But when you actually ask people about the decisions they've made, the insurance providers that they have taken out contracts with, then the trust rating tends to go up quite a lot. And that's because when they actually have an interaction, more often than not, it is quite a positive one. And that's in no small part because a lot of work has gone into streamlining, digitizing, and making use of the sort of interfaces that customers have come to expect with your Amazons and your Facebooks of this world. So we have an opportunity, I think, in insurance to do more of that if we can build in more touch points with the customer and develop a bit more of an ongoing relationship with them. So it's not just taking a premium, which hurts your bank account, and therefore it's only a negative interaction that the customer has. On the use of sort of data points and sort of trying to extrapolate and get to better know the customer, there's certainly a lot of opportunity there as well. But we've also seen more from the general insurance side of the house in the ABI that does come with some risks and difficult questions which need to be considered around about how much of that data do you use when building your pricing models, and that can often actually have the opposite of the intended effect of reducing trust levels. So people think that you are being too invasive into their lives, and so that's an ongoing question, and one which I think will play out over the next 10 years as big data and AI becomes more and more prominent in industry.
Let's move on to the banks, and I want to bring you back in here, Rob. You talked about that aggressive sales culture, and you called for cease and desist on that. Have they?
Well, all of the banks have now committed to do so. So obviously, these are changes that take some time to put into place and to make effective. And part of our job is going to be to assess how effective the changes have been and whether they've gone all the way up through the institution the way they need to. So, yeah, I mean, a positive of this situation is that, as I said in my speech, there's a lot of other jurisdictions that have chickened out from going that extra yard of basically saying, for your own employees where you have control over them, you need to come up for a different way of paying them. And frankly, credit to the industry for understanding that's what they needed to do.
Can you give us an example of the kind of aggressive sales culture that you said must stop, that used to happen and you believe is not happening now?
Yeah, quite simply, and I've seen this myself in banks in the UK and doing this work. If you have a sales model where the frontline sales force are told, act in the interest of the customer, be nice to people, don't sell them rubbish, but you will only get paid the top 20% of your compensation if you hit these sales targets. You'll be, and I've seen this in a bank branch in Scotland as it happens, if you don't sell the extra 20% of products, you'll be on the list of shame on the wall in the branch. You get to miss out on morning tea on a Friday because you haven't sold enough product. Now, a lot of those incentives are behavioral, and so they are difficult to shift. But the financial ones, if you sell 15 of these month, you get to people who are not paid a huge amount of money, enough money that maybe they'll be able to afford a holiday that year. They are going to sell that 30-year mortgage to the 80-year-old woman who just walked in. It's going to happen. That's human behavior. Look at Wells Fargo. I mean, what a perfect example, right? You pay people to open bank accounts as your sales force, your tellers, and they open bank accounts. People didn't know they'd open bank accounts. They didn't want the bank accounts. But if you incentivize people with hard cash, it's effective, and people change their behavior.
Jeff?
I agree with everything that Rob said, and what we've seen is that, in a sense, banks started thinking about it frontline, and then they have extended it further up the management chain, which we're really pleased about. I mean, there were some discussions we had initially where, gone out there, and then the managers still had the same incentive challenge, and the staff are going, well, my manager's on my back all the time because his, or her remuneration depends upon it. And we go, well, that's a bit weird. So we're really pleased to see the banks reconfiguring, and obviously it takes effort to put this into what is a good performance management regime, when ultimately you want, the performance of the company has growth dimensions, has profitability dimensions, has, long-term customer satisfaction dimensions, and so forth. But let's put our energy constructively into the right place on this, rather than thinking that all we need to do is hotwire at the front end and the sales. A sale is not, and the outcome that we're looking for. And I think as we're seeing that done, and the feedback we're getting from institutions that are further down the actual execution path on this, is they're not seeing deterioration in performance. They're seeing they can, still maintain market share and performance and keep going. And put positive energy in, I guess, is what we're looking for. It'll pay off.
Well, how far up the chain should this go? I see a question here. Should executive remuneration be considered as part of conduct?
Oh, I agree. This is part of the discussion right up at that level.
Well, what would that look like?
Well, that's the thing that boards are working on, in terms of, there is going to be a change in exec rem structures. They are putting proportions in there that reflect how they can measure the sort of change going on in the business, the culture, the long-term growth of the business. Some of it may be more deferred over time, so that you can get a claw back when things go wrong. There's all sorts of mechanisms that can attend to this. So I agree, it's not just the last thing you want in a confidence in an industry is we all focus on the front line who's doing this. This is deep in the DNA, the systems and the governance of the organisations.
And anyone can pick up on this, but is part of this about trying to develop more long-termism than short-termism, I suppose?
Definitely. I think you can't, well, certainly in the life insurance sector, you can't have a short-term view. It's a long-term game that we're all in. And I think, we just have to look across the ditch at some of the, the examples where short-termism has played a role. And I think we've really, really got to stay focused on making sure the decisions we take today are going to benefit long into the future. And also ensure that, we're future-proofing not just our respective organisations, but we're future-proofing the industry. Because at the end of the day, we all want the industry to thrive, because that's actually good for New Zealanders. And I think, that long-term view is really important.
Tim, this is a little bit esoteric, isn't it? I mean, what sort of challenges does this pose for law firms and for legal advice?
Yeah, that is an interesting question, and esoteric, as you say. I mean, I think let's go back to human nature, though, and it's important to recognise that, particularly if you're of the egotistical school of thought, that people are motivated by incentives, and what we want to make sure is a matter of alignment more than abolishment, and so we need to think quite carefully about what those incentives are, and that implies to management, it implies in the insurance sector to commissions. A simple blanket ban, as they talked about in Australia, that I don't think had a great deal of depth of thought attached to it. But what we need to do is make sure that when we develop what we're doing, and there's an awful lot of work done in executive remuneration packages around structuring things to get the best outcomes for the business, and the best outcomes for the business very often are aligned with best customer outcomes as well. One of the things I'm concerned about is some of the rhetoric I've seen around not being able to have a balance of volume sales within a structured remuneration structure, and I think that some thought needs to be given to that. I can see the desire to move away from solely volume sales based incentives, particularly in insurance, but I think that is still a component, because you want insurers to get out of bed, distributors to get out of bed in the morning and sell insurance. Insurance is not bought, it's sold. If I think about the three people I was thinking about when I was invited to be on this panel, all three of them had cancer. One 38, one 49, and one 54. This was 2 weeks ago. Now I have to say there's one of them left. They are very, very pleased that someone sold them insurance, and we need to bear that in mind when we are thinking about the majority, and how we're going to affect the majority by dealing with those difficult cases of churn and other things, and making sure that we incentivise the good outcomes, and those good outcomes can be incentivised through incentives. So a wee bit off track and a wee bit more philosophical, but those are some of the thoughts I've had.
No, good answer. And stick with us, because I'm going to come back down this way to wrap up, and I want each of you just to talk about what you see as the big challenges over the next year. And I'll start with you, Tim, and we'll come down the line. But I want to put this question to you, Rob, that's up the top there of the screen, because it deals with something we haven't talked about, which is financial literacy in New Zealand. The question asks to Rob, when designing products, what level of knowledge, expertise should the financial services industry expect of their clients and consumers, given New Zealand's low financial literacy rates?
The point was made earlier about simplicity, and I believe very strongly that it is easy for people in the industry to regard as simple that a product that, when sold to someone who's not familiar with the jargon and how it works, is very complicated. And when that person comes to deal with the product down the line, they're probably in a period of high stress, one way or the other. So I don't know that financial literacy rates from the research I read here are significantly worse than most other developed jurisdictions, but they are poor, and that's the case across the world. So my take is that the industry constantly overestimates the capacity, whether that's time or capability, of people to make complicated decisions around supposedly simple products. And I think if the industry takes that step back and thinks, rather than adding tweaks and bells and whistles and desperately trying to distinguish ourselves by being clever with this product, let's focus on making sure we sell it to the right people and they understand what they're getting. So I think taking account in as little a patronizing way as possible, the fact that people don't have the bandwidth to spend a lot of time on a lot of these decisions is really important.
Yeah. Okay, let's just wrap up. Two or three quick points about what you'd like to see in a year's time if we were sitting back on the stage in a year's time. Let's just go down the panel and do that, starting with you, Tim.
Well, goodness, there's a lot ahead of us in the next year. There's been a lot behind us and dramatic change over the last year. Dramatic, I think, was your word, Rob. I would like to see the continuance of what we've seen over the last short while with the reviews and the huge impact that's made on businesses in the insurance area. I would like to see successfully the transition for advisors into the new regime without great considerable cost and hardship. Every piece of regulation has a benefit, but it has a cost as well, and that trade-off needs to be thought of very, very carefully. And the transition needs to be made as easily as possible and efficiently as possible, so for in the best interest of the industry.
I'm aware this is going to sound very self-interested, but I think more research is what I'd like to see. I spend a lot of my time trying to bring the voice of consumers into organisations, and I think that's going to be a really crucial part of rebuilding trust in the industry. There's just three things that people say they want, the top three: transparency, simplicity, and no upselling. And I think that people who can think about those and figure out how you build those in a way that, works for your particular situation is part of rebuilding that trust. But bringing the voice in is what I'd say.
I think what I'd like to see is some evidence that customer trust is increasing in a year's time, and I think it's increasing, reinforcing your comments actually, Tim, it's increasing because as a sector that we're actually thriving, not dying in a year. And I think that's going to take a lot of continued mahi from everybody. And I also think it's going to take a lot of clarity, commitment, and perseverance, because it is not going to be easy. But as I keep saying to my own team, nothing worth fighting for is easy. And I think there's certainly enough of us in the industry that are passionate about seeing us thrive.
Jeff?
Well, confidence in the financial system it's the lifeblood of it. It really breaks apart if we lose it. So we've got to maintain it and see that flow through that system, and that means confidence in the regulators as well as in the industry, and we want to see that. I think in practical terms, risk management is at the heart of a lot of this. We often think of risk management as a sort of a thing that we do to hone down risks, but it's also the thing that creates opportunities. When you've got good risk management, you're much more confident in where you're going on something new, on something you're investing in, something you're growing, and so where we sort of spend a lot of our time and wanting to see is that maturation at boards and exec team, that they're thinking deeply about their risks and the way to manage and anticipate. And it comes back to that long-term issue as well as the shorter term. So I guess we look for growth and maturity in that as part of the way of sustaining the lifeblood and sustaining the vigour and success of a creative industry.
One of the unintended consequences of the reforms that we went through in the UK was when commissions to advisors were banned, the number of advisors went down, the cost of advice went up and became a lot more explicit to customers. And what that meant is there's now about 2/3 of people in the UK who either won't pay or can't pay for financial advice. And when the state is expecting people to take more and more responsibility for their own financial well-being, I think that is a real concern. And so if I was to be back here in a year's time, I would love to sort of see how you here have grappled with that question and come up with any ways for more people in the advice gap to access good quality advice, so I could then steal those ideas and take them back to London.
Well, Rob, you got the first word. Looks like you're going to get the last one too.
That's good. So I think Jeff mentioned confidence. What I'd really like to see is the confidence in consumers, the confidence in the media, the politicians and the regulators that this is going to be really hard, right? None of this is easy. It's going to require enormous commitment, and saying it is one thing, but actually creating organizations that deliver this is really difficult. So what I'd really like to see is the confidence that everyone's accepted how hard that is, but how necessary it is, and that we feel we're further ahead then than we are now.
Tūtaua mai runga, tūtaua mai roto, tūtaua mai roto, tūtaua mai waho. Kia tau ai te Māori tū, te Māori o ra kiti katoa, haumi hui taiki. Thank you very much, and thank you to our panel, Tim Williams, ho mai te paki paki, David Talbot from UMR, Nadine Teddy-Order, Jeff Baskand, Stephen Findlay, and Rob Everett.